markets hoping to shake off 2022's gloom, with investors looking to optimism in China's reopening and a less hawkish Fed. Joining us now with more, we've got John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. John, great to have you here with us today. You look out into 2023 and you think about some of the things that we hope to leave behind in 2022. Which of those factors do you think will still loom large as we move into next year, though?
Well, thanks for having me on the show. Really, it's great to be here on Yahoo Finance. Would have to say, when we look at the picture here, the risks remain things like COVID, China policy towards COVID, issues related to Russia's incursion into Ukraine and how that will turn out. So when we consider that, we've got to think that with the Fed still in a rate hike cycle, plenty of uncertainty remains on the table. That said, we think a lot of this has been priced into the market this year. We'd have to suggest that indeed the market has been oversold, whether it's the NASDAQ, whether it's the S&P 500 or the small caps. So we would have to think that next year, the 2023, is likely to be a better year. I think the Fed's going to keep raising, okay, but we think the adjustments will be modest. We're not looking for a pivot. We're not looking for a pause, at least through the first quarter into the second quarter. But we do think that companies have shown that they can be highly resilient in challenging markets since the financial crisis, through the pandemic, and thus far in these rallies that we see.
Hey, John, it's Julie here. You tend to be, I would say, more optimistic of the folks that we talk to. And I'm curious, as you look ahead to next year, since you're already looking at a less worse year, not like gangbusters, but less worse, what could go even better, right? And you list some of these upside risks in your look ahead note, but what to you is potentially the most likely, the thing that you'll be watching most closely?
Well, we'd have to say that the consumer will likely prove to be more resilient, as there's still, based on the JOLTS index, plenty of jobs for those who are unemployed to consider, at the very least. And in the meantime, consumers are keeping spending, even though they're relying more on credit cards. The reality is that the consumer remain, whether it's for, for experiential joy or for buying things, the American consumer remains positive related to spending, and I think has a fairly realistic view in terms of inflation. I also think that the Fed will once again be proven to be successful ultimately. It's prone to make mistakes, but ultimately the Fed is the arbiter in terms of setting interest rates via its benchmark rate. Monetary policy, is you can see it in those housing numbers that we saw earlier this week, and the numbers today that you were just talking about. They're beginning to have a genuine effect on this inflation that has been at 40-year highs.
John, if we get stagflation next year and no recession, does the S&P 500, let's single that out, recoup all its losses from this year and perhaps even more?
Well, it's the stagflation question is when we'll have to see what happens with the job market in terms of how that really comes out. But based on what we've seen over the last 15, 20 years, and even longer, we publish within our weekly piece and our monthly chart book the effects on the S&P 500's performance of interest rates, not only market interest rates, but also Fed policy. We'd have to think that there's a real good chance that we are going to see at least somewhat of what we would call a do-over year. I don't know if it's going to look like 2019. Remember, in 2018, the Bears ruled in the fourth quarter. They thought first quarter was going to be terrible. Boy, were they wrong. And the markets came back powerfully that year through the whole year. So we think you have to be, if anything, we think upside risk is probably greater than downside risk here. The biggest problem for the Bears is they tend to project whatever is negative today, they project it forward into infinity. And, the world and cycles are what they are. Things can change. Who would ever thought that President Xi would cut out the zero COVID policy so fast? How long that lasts? Well, of course, that's up to President Xi.
So, John, all these factors considered, what's your top idea for 2023? What is the area that, for investors, they've heard about how defensive they needed to be in 2022 and 2023? Where would you say that they should perhaps kind of pivot their attention to?
The overcall still remains buy growthier value and garpier growth. So we like, when it comes to technology, and we think tech has been grossly abused this year, you want to own those companies that are deep, their services or their products are deeply embedded in the lives of both business as well as the consumer. A lot of those stocks are deeply on sale, and some of them even pay dividends, modest dividends, and sometimes even better dividends. We continue to like chips. Last I looked, the chips were still doing well from the October 12th lows, up double digits. I think about 12% is what I recall off of the top of my head. Last I checked my screen this morning. And would have to say, you want to own consumer discretionary. Don't bet against the U.S. consumer. When times are flush, they spend like sailors on leave after a long tour of duty at sea. But when times are tough, the American consumer validates their work and their existence by shopping. They'll just move to private label goods, discount stores, or what have you. And so we think, look at the consumer, technology, and of course we've been adding for years now exposure to industrials. The industrial sector looks like a great place to be, not only from a defense position, but also power generation, as well as aerospace, both commercial and defense. And we have to think that with most of home appliances now connected to, or many connected to the Internet of Things, it's a good space to be in. And financials still looking very cheap here. If we can get away from all this fear about the pending recession that everybody is certain about, we can probably see the financials have another period of a nice bounce.
John, just real quickly here, where do you stand on the great bond comeback of 2023 that everybody seems to be talking about?
Julie, I think this is central to it. That what all the fuss and muss about this that happened this year was, it was the end of free money, is what the Fed was saying. We had easy money during the financial crisis, and coming out of it, we went to free money in the pandemic. That's not good. Bond issuers are beginning to pay for the privilege of borrowing money, giving something to bond buyers for the risks they take related to credit, callability, and the default risk. And so we've got to say, I don't know if it's a 60-40 play, but maybe a 70-30, 70-25 with fixed income, at the very least, a 15 to 18% exposure in a model that we follow.
John, always great to catch up with you. Happy New Year to you. Good to talk outlook with you. John Stoltzfus is Oppenheimer Chief Investment Strategist. Thanks.
Thank you.